Have you ever wanted to know more about the Federal Reserve? You know, what they're about, how they're formed, and why they do what they do? Have you ever wanted to know about what a bull market is and when is it not a bull market? Have you ever wanted to know how to effectively diversify a portfolio? Well, you're going to want to join us today because we're going to be talking about all three of those things, so stay tuned.
Retiring Well, brought to you by Centennial Wealth Advisory, financial advisors specializing in retirement planning and serving all of Northern Michigan. Retiring Well, helping you plan for a successful and comfortable retirement. Retiring Well, plan to retire well.
Have you ever wanted to know what the Federal Reserve was? You know, is it a private agency? Is it a government agency? Believe it or not, it's both. When Congress formed the Federal Reserve, it was formed to be the bank for the banks. Okay, now think about this. If you've ever seen that movie, It's a Wonderful Life, when everybody puts a run on the credit union, they show up and everybody wants their money at the same time, and the banker has to basically explain to them that all their money is being loaned out, that the money that so-and-so put in their savings has been loaned out for a car loan here, and you know, the banks are not fully liquid. So the Federal Reserve was created to be a bank for the banks so there wouldn't be a run on the banks and collapse the whole financial system. But when it was first formed, you know, there was great debate among Congress whether it should be a private enterprise or it should be a government enterprise. And believe it or not, at the end of the day, they ended up with a compromise. It's a little of both. You know, they got members that are elected by the government to serve on this committee. They make up probably about half the committee, and then the other half of the committee is made up of leaders of the other regional banks, the central banks in the United States. So they all form a committee, and between the government sector and the private sector, they're making a decision on what the rates are going to be, how much money supply is going to be available for loans, and the such. So, you know, the Federal Reserve has what you call a dual mandate. Their mandate is basically to keep unemployment low, okay, and then also to keep inflation in check. For the most part, these are opposing mandates, right? Because typically when you have low unemployment, you know, wages rise and then you have inflation. So they have to find the balance. Now, they typically want low unemployment, but they want to keep inflation about 2%. And they've been able to succeed at that mandate with inflation of recent, which is why they kind of slowing down their possibility of raising rates any further. In December, they raised the rate and the market reacted unfavorably, and now you see them kind of slowing down, saying, okay, we're either going to maintain or we're going to start cutting back interest rates because we might have overreached, but that's kind of the direction they're heading right now. Right now, the Fed rate remains about 2.5%. The Fed rate, you know, when they've in the past decided to lower rates, this chart shows that usually following there's been a recession. Now, there's a lot of people, recent news, as the Fed's talked about lowering rates, they reacted favorably to that. Why? How can that not be good for business, right? But let's remember, the Feds are only going to look at lowering the rates if they see economic slowdown coming in the future. So there's a lot of people running for the fire when maybe they should be running away from the fire. If you look at our policy compared to Europe and Japan, you can see that as we've been raising our federal rate, Japan and the European Union, they're basically at negative rates. Now, why would we ever have negative rates, right? Why would you pay to have a bank, you know, hold your money? It's only because that you wanted to keep it safe, and you didn't want it to be out there in the market. But you can see as our rates, you know, raising has been much significantly different than what the rest of the world has been doing. And then you look at the balance sheets, how much money they're keeping out there in loans. It's been much different as well. As we've started to taper, the rest of the world has been increasing theirs. Do we know what the Feds are going to do? This is an interesting chart. The red line shows what the Fed rate was or what they did. All those dotted lines is what the rest of the Wall Street and pundits believe they were going to do. Do you see any correlation at all? Not at all. The truth of the matter is we don't know what the Feds are going to do and why they do it. They come out and tell us, but based on this chart, for the most part, we're always wrong in trying to estimate what they're going to do. This one is a concern to me because you can see after the last recession, when the Feds decided to increase their balance sheet, increase the amount of money available, they started off at $1 trillion. They got as high as $4.5 trillion. It dropped to about $3.8 trillion. So they've basically quadrupled their balance sheet of the money they had available out there in loans. And when they started talking about tapering, look what the market started to do. I dare say, I think our economy has been way too dependent on this easy money policy and low interest rates. And what they're going to do going forward could have some grave effects. If you want to know what corporate debt's done during this time, all you have to do is look at this chart. The Feds raised their balance sheet from $1 trillion to $4 trillion, and look what corporate debt's done in the same time. Only go up by about the same amount. Very concerning because much of this has to be refinanced. So anyway, hopefully this gives you a little bit more idea of what the Fed's about, what their mandate's about. So just continue to join us. We got more to come.
Yeah, that was really interesting, Larry, looking at that. And I think of guys today when people are talking about interest rates, and it seems like, oh, the Fed's going to talk about the interest rates and things are going to move. And when we look at it, we're looking at, okay, it's just going to move this much, but it creates all this media frenzy and the markets then are reacting. But really, the interest rates are really just sliding one way or another, just usually by a fraction of a percentage.
Right. And I always find it interesting, too. We've become a society, economy, individuals that have really become adapt to just low interest rates. They're moving around. They're still at a very, very low level. It wasn't that long ago, we hear our clients talk about all the time, oh, I remember, getting a CD for 12%, or I remember my dad going into the bank and getting a CD for, 12, 13, 14%. Now, granted, mortgage rates and borrowing money was very expensive at the time, but we really have just become accustomed to these low rates and used to getting cheap money.
Yeah, I'm glad you brought that up because I think our economy has gotten too used to these low rates. It bothers me that the Feds can't normalize the interest rate, which was what they were trying to do. I mean, we know recession is coming, right? Mm-hmm. It's just a matter of when. Well, when we get there, it'd be really nice if the Fed's got a handle to pull. But now they're talking about actually lowering rates again, and I know that's going to probably the market's going to react favorably to that in the short run. But folks, how can that be good, right? How can that be a good thing that the Feds are lowering rates? Because that means they know something we don't, right? So all the more reason why you want to take this opportunity to have your portfolio looked at, because harder times are coming. We know they are, so we want to be ready. In the next segment, I'm going to talk about bull markets, what they are, and kind of a new way to look at them. So stay tuned.
Today's retirement challenges can be mastered. Knowledge is power because you can confidently plan ahead and make educated financial decisions for a successful and comfortable retirement. We are Centennial Wealth Advisory, financial advisors specializing in retirement planning, serving all of northern Michigan with offices in Traverse City, Cadillac, Petoskey, and Gaylord. And we invite you to an informative and exciting live event with a complimentary gourmet dinner. You'll learn highlights of the new Tax Reform Act, the difference between the fiduciary and suitability standard of care, how an IRA gets taxed to a surviving spouse, how two similar portfolios can end up with two drastically different results, what a bull market is and how long it can last, and much more. Call 888-608-5825 to register and choose the date and location that works best for you. Tuesday, August 13th at Stafford's Bayview Inn in Petoskey. The live event starts at 6 p.m. and is free to attend with a complimentary gourmet dinner to follow, but seating is limited and fills quickly. Call 888-608-5825 to reserve your seats today. There is no cost and no obligation. Don't miss this important live event. Educated financial decisions. Call 888-608-5825 today.
Hi, welcome back. Listen, in this segment, I want to talk about what is a bull market, what is a bear market, right? A bull market is when you haven't had a greater than 20% correction in the market, all right? So it has to drop by more than 20%, and it has to last longer than 2 months. All right, now there's been plenty of times we've had the market correct, drop for, short periods of time and come back, or not drop 20% and come back. But we haven't had, since March of 2009, we have not had the market drop by more than 20% and have it last more than a 2-month period. Now, we understand markets are cyclical, right? You'll have periods of expansion, usually followed by periods of contraction. The whole idea behind markets is knowing where you're at in that cycle. I would dare say, with all market fundamentals right now, as good as things are, we're probably right at the top. Things are, unemployment's at a historic low, consumer sentiment high, small business sentiment high. Everybody's feeling good about the economy. But when things are usually typically been this good for a period of time, usually contraction or recessionary concerns have usually followed. So it's just understanding where you're at in that cycle. Now, is a bear market coming? We can't predict that. This bull market could have a lot longer left to it. But just as a general rule, typically when we've seen periods like this, there's usually periods where it can drop. Now, as I indicated in the first segment, with the Fed and how dependent our economy has become on this high monetary policy, or all the money that's out there with the low interest rates, that's concerning, because much of what's happened the last 10 years, what we've seen are called a bull market, has been propped up by low interest rates and a lot of money supply. And you can see, as we talked about in the first segment, as soon as the Fed started normalizing that, or raising rates and dropping the money supply down, what did you see markets do? They reacted very negatively. So this is concerning, because when the next recession comes and we have maybe that corporate debt that kind of plays a part, and we see default rates rise, what are the Feds going to do? What handle do they have to pull when they got interest rates so low and the money supply so high? Folks, that's concerning. This is the time to have somebody take a look at your portfolio and see how you're positioned. I dare say, recession's coming. It's just a matter of when. We don't know, but can't pick a better time, but when times are good, to make sure that you're positioned appropriately. So give us a call.
Larry, that was a really great segment, and really timely too. We've been fortunate enough to have a great up run in this market here, but the one thing I think that causes is a disadvantage is complacency. Especially you've been enjoying these great returns, and it tends to be what happens during those times. You stop checking your account maybe as much, or you don't look at your statements, and you just start to kind of get complacent with what's going on in the news and the market and your account. You're fortunate enough, you see your statements, hey, I made money again, things must be good. But you lose sight of what's in your account. What is diversification? What's happened to those funds? And as this run has been going up, guess what? From when it started, you're 10, 11, 12 years older than when this bull market started. So what does that look like? If you're near retirement or in retirement, this is a critical time to be looking at that.
Yeah, good point, Art. And that's a perfect example, somebody that I'm working with right now, and they're having that struggle of saying, well, I've been averaging 12% returns over a certain amount of time frame. If we scale back the risk, I'm not going to see that anymore. But they're also at a point now where they're saying, hey, I'm retiring here soon, and I can't really afford to take that major step back. And that's where I think back to a client that came to us a couple years ago and talked about that. Back in 2007, 2008, was getting close to retirement and basically preparing mentally for that, but never adjusted their portfolio to match that, and ultimately saw the market take a major hit in their finances. And they said, as much as that money was important, it was that time. They ultimately ended up saying, I worked another 5 years of my life that I can't get back, and that's what hurt them more than the financial piece.
Yeah, I like what Art was saying, the fact that, people are getting complacent. This is the time when times are good, to see how you're positioned, Are times the same as they were back in 08 or back in 2000 when we had the last two recessions? Is it going to hold up the same way? You know, this is why you want to pay attention. But people, when things are good for so long, they just start thinking, oh, you know what? I'm just going to leave it alone. It seems to be doing fine. Yeah, there's a lot of volatility, but let's just just stay the course. That's quite the opposite of what they should be doing. This is the time to pay attention, especially when we know we're in the late stages of this bull run. Wouldn't you agree? So, anyway, in the next segment, Mike is going to be showing us what is called effective diversification. So stay tuned.
Hi, I'm sitting here with Larry Flynn. Thanks for being here, Larry.
Thank you, Mike.
He's one of the advisors at Centennial Wealth Advisory. And folks, as you may know by now, we certainly invite you to come visit with us. It's absolutely free to get a second opinion on your retirement planning. And I think it's important to get a second opinion from someone who's a specialist when it comes to retirement planning. And Larry, I'm sure they're wondering, if they pick up the phone and they call and come visit with you, what can they expect? What's that experience like?
Well, Mike, they can expect not to get hard sold, okay? We're going to greet them warmly. We're going to sit down and talk to them a little bit about maybe their story, where they're from, where they grew up, how they met their spouse, what they're dreaming of doing once they get soon to be retired or retired.
Kind of what are their goals, right?
Yeah, what are your goals? We're going to talk to them a little bit about who we are, what we do, show them how we do things, especially dealing in the market realities we find ourselves in today.
Got it. So essentially, they're coming in, you're learning a little bit about what's important to them, what their goals are, what they're trying to accomplish. I'm sure you're taking a look at what they're doing so far. You maybe share a little bit about you, and it's just in a very relaxed atmosphere.
That's right.
And there's no cost to do this. Is that correct?
No cost. No cost.
All right. So, folks, there you go. I mean, it sounds very simple, very easy, very laid back. There's no reason for you not to just pick up the phone, call the number on the screen, come visit us. Get that second opinion. You'd be glad that you did.
We look forward to helping you plan to retire well.
All right, this week in Chalk Talk, we're going to talk about what effective diversification means and how to achieve effective diversification. What is the goal? The goal is simply this. We want to have higher returns if possible, but more important than higher returns, I mean, if you can get the same returns, that's great, is shrinking the volatility, having more consistency in a portfolio. And I'm going to share with you what people normally do and then how you get effective diversification. So most of the time, think about when you started investing, right? Think back to when you started saving money. You probably did it in a 401k or an IRA, something like that, and all you're trying to do is grow the portfolio. And what you would do is you would find investments, usually mutual funds in your 401k, and they were all focused on, right here, growth. All focused on growth. And another word here is there was some risk involved, right? Because when you put money here, you know in advance. Some years, you are going to make money, right? Some years you're going to make money. In fact, some years you're going to make a lot of money. That's fun, isn't it? But what else do you know? Yeah, some years you're going to lose money, and in fact, if we're honest, some years you're going to lose a lot of money. Now, whenever you put money in this environment, there's always a factor, a four-letter word called time. And by the way, what am I talking about here? Stocks, bonds, mutual funds, that kind of stuff. You need time because hey, I'm going to make money some years, I'm going to lose money some years, but over time, you should do pretty well, right? That's the idea. But then what happens? You get a little older, you get closer to retirement age, and you start thinking, wait a minute, I know in the last 20 years, there's been twice when these accounts have lost half their value. Twice. I know that. And you think, oh man, I need to protect some of my money. And so what do? You take some of your money and put it over here, where it's safe. And what is that? That's at the bank, right? You put it in savings, checking, whatever. And hey, the good news is the money's safe here, but what's the bad news? Yeah, you said it. You don't make any money. Don't make any money. But what are we trying to do at the end of the day? We are trying, you are trying, everybody's trying to find this middle ground, this happy place. And what you're doing is you're saying, I'm going to take some percentage of growth and some percentage of safety, and the idea is that, there'll be enough growth from this percentage and enough safety from this percentage where, you find that happy medium, right? That's what you're trying to do. Well, at Centennial Wealth Advisory, right there is where we live. That's where we live. We don't try to do everything for all people. Our job is for people who are retired and nearing retirement, it's to live in this space and develop a portfolio that makes the most of that middle ground, right? That middle ground. And in order to do that, to get this effective diversification, you need three things. Okay, there are 3 steps. Here's the first. Number 1, principal protection. The first thing you need to do when you are building an effectively diversified portfolio is you've got to decide how much of your money do you want to protect if all heck breaks loose and markets go crazy. How much of your money do you want to make sure doesn't go south? How much you want to make sure you've protected your principal no matter what? Okay, how much of your principal needs to be protected? But I don't want to earn 1% on that. I want to get a little bit better. I'd like to try to get north of 3 if I can, 3, 4, 5, 6 if possible. Second, has to do with your asset allocation, right? Remember at the beginning of the show, what do we say? Real estate, location, 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 asset. Yeah, asset allocation is part of it. But I want to dive a little deeper here. Number 1, when you're putting together a portfolio, you need to dig deep. And here's what I mean by that. It's not just stocks, bonds, mutual funds. Okay, that's not it. I mean, you also want to look at, say, real estate and commodities like gold or oil. You need to be looking at all kinds of different things out there. Maybe you should be looking at covered call writing or maybe you should look at some, catastrophe insurance, whatever it is. You need more than just stocks, bonds, mutual funds. What else? Management style. You need to diversify across management style. Different managers manage money differently. You could have a manager, one manager does large company stock, and what they do is they say, these stocks I think are undervalued. And that's how they buy their stocks. Another manager in large company stocks may go with the trend and say, oh, those stocks are up, I'm buying. Oh, now they're down, I'm selling. They own the same stocks a lot of times, but their returns are different. In any given year, one's better than the other. But the key is when you put them together, it's more consistent, more consistent. And then third, I'm going to call it placement. Now, placement means simply this, and this is something a lot of people don't talk about. You need to have the right assets in the right places. You don't put, if you have IRAs and after-tax accounts both, there's certain assets that just work better in IRAs and certain assets that work better in non-qualified. If that makes sense. Placement. And at the end of the day, third, make sure you're looking at alternatives. There are a lot of types of alternatives out there. There's many different types. And depending on your circumstances, some might work better than the other. But they play a role. At the end of the day, when you live in this world and you build effective diversification, then what you're able to do is you're able to make things more consistent, protect yourself better against the down years, still make good money in the up years. And the question you really have to ask yourself is, have you had this conversation with your advisor? And if you're doing it yourself, maybe you're managing your own 401k, your own IRA, I promise you aren't doing this stuff. Probably worth the phone call, probably worth coming in to visit to see if something like this could benefit you with your planning.
Today's retirement challenges can be mastered. Knowledge is power because you can confidently plan ahead and make educated financial decisions for a successful and comfortable retirement. We are Centennial Wealth Advisory, financial advisors specializing in retirement planning, serving all of northern Michigan with offices in Traverse City, Cadillac, Petoskey, and Gaylord. And we invite you to an informative and exciting live event with a complimentary gourmet dinner. You'll learn highlights of the new Tax Reform Act, the difference between the fiduciary and suitability standard of care, how an IRA gets taxed to a surviving spouse, how two similar portfolios can end up with two drastically different results, what a bull market is and how long it can last, and much more. Call 888-608-5825 to register and choose the date and location that works best for you. Tuesday, August 13th at Stafford's Bayview Inn in Petoskey. The live event starts at 6 p.m. and is free to attend with a complimentary gourmet dinner to follow, but seating is limited and fills quickly. Call 888-608-5825 to reserve your seats today. There is no cost and no obligation. Don't miss this important live event. Educated financial decisions. Call 888-608-5825 today.
Guys, that was a great segment Mike did. I love the way, he drew that out. You got people that got the, the growth portfolios, right? And the pluses and minuses that kind of come with that. And then you got the one over here with safety, but where we're spending our time is really trying to build a portfolio that has a little element of both, right? It's kind of like the tyranny of the or, genius of the and I heard a long time ago, right? We all think it has to be either this or that, but maybe the genius is in the and there, right? And that's effective diversification, is having a strong element of all of those.
Yeah, and one of the simple things that I think of, guys, is it comes back to that rule of 100. So if you're not familiar with that rule of 100, it's simply looking at, here's 100 minus your age equals the percentage of the portfolio that you might want to take risk with. So if you're 65 years old, it's basically saying, okay, 100 minus 65 equals 35% of the portfolio, or maybe you want to have that in the growth or the risk area, 65% maybe more on the conservative side. So it's just a general rule of thumb that's helpful as you're looking at your retirement assets.
I think of this, and I really appreciate what you guys just said and what Mike walked through here, because, it really is fitting with even the segment we just did before that. Diversification, what is that? How do you want to think about that? So often clients come in, or they've been told they're diversified, and what does that really mean? Yes, you may own multiple stocks. You don't have all your eggs in one basket, as the old saying, but there's different ways to look at that. And as we've, kind of run out this bull run, how are you prepared to handle that? What is your rule of 100? What are some of these things that how are you structured to do that? And so if you're nearing retirement or in retirement and you don't know what it is, or it's been a while since you've looked at your diversification, now is really a great time to be doing that and understanding what that really could be. So thank you again for watching Retiring Well. And once again, here at Centennial Wealth, we offer a no obligations free review of your portfolio. We can analyze everything and break down what your diversification really is, and really what kind of that max drawdown might be if we are faced with a recession coming up here. So thanks again for watching Retiring Well this week, and we'll catch you right back here again next week.